Question 1. Benchmark analysis indicates that a prospective client for Old Mutual has expressed a strong desire for aggressive growth investments to achieve significant capital appreciation within a short time frame. However, during the initial fact-finding, the client also revealed a low tolerance for volatility and a significant aversion to any potential capital loss, citing past negative experiences. Considering these conflicting indicators, which of the following represents the most appropriate course of action for the Old Mutual representative? Option A. Engage in a detailed discussion with the client to explore the underlying reasons for their aggressive growth objective and their stated risk aversion, explaining the inherent trade-offs and presenting a range of suitable investment options that balance growth potential with their comfort level for risk. Option B. Proceed with recommending a portfolio heavily weighted towards high-risk, high-return investments, emphasizing the potential for rapid capital appreciation to meet their stated growth objective, while downplaying the associated volatility and risk of capital loss. Option C. Advise the client that their stated objectives and risk tolerance are incompatible and suggest they reconsider their financial goals before proceeding with any investment advice. Option D. Focus solely on the client's stated desire for aggressive growth, assuming their understanding of the associated risks, and recommend a selection of the highest performing, albeit most volatile, investment products available through Old Mutual. Correct answer is A. Engage in a detailed discussion with the client to explore the underlying reasons for their aggressive growth objective and their stated risk aversion, explaining the inherent trade-offs and presenting a range of suitable investment options that balance growth potential with their comfort level for risk. Explanation. This scenario presents a professional challenge because it requires an employee at Old Mutual to navigate a situation where a potential client's stated investment goals appear to conflict with their risk tolerance, as indicated by their financial situation and stated preferences. This conflict necessitates careful judgment to ensure that any advice provided is suitable and in the client's best interest, adhering to regulatory obligations. The correct approach involves a thorough fact-finding process to understand the client's true objectives and risk appetite, followed by providing clear, unbiased explanations of suitable investment options. This aligns with the regulatory framework governing financial advice, which mandates that advisors act in the client's best interest, conduct appropriate client assessments, and ensure that recommendations are suitable. Specifically, this approach upholds principles of client protection and fair dealing, ensuring that Old Mutual meets its fiduciary responsibilities and avoids misrepresentation or the sale of inappropriate products. An incorrect approach that prioritizes immediate sales over client suitability would be ethically and regulatorily unsound. This could involve pushing a high-risk product simply because it aligns with the client's stated, but potentially misunderstood, goal of high returns, without adequately addressing their demonstrated risk aversion. Such an action would violate the duty of care owed to the client and could lead to regulatory sanctions, reputational damage for Old Mutual, and financial harm to the client. Another incorrect approach might be to dismiss the client's stated goals entirely without further exploration, which could be perceived as patronizing and fail to uncover the underlying motivations for their aspirations, thus not providing truly tailored advice. Professionals at Old Mutual should employ a decision-making framework that begins with a comprehensive understanding of the client's circumstances, objectives, and risk tolerance. This involves active listening, probing questions, and transparent communication about the trade-offs between risk and return. The framework should then guide the selection of suitable products and strategies, with a clear rationale that links back to the client's profile. Finally, it requires a commitment to ongoing review and client education to ensure that advice remains appropriate as circumstances change. Question 2. System analysis indicates that a senior analyst at Old Mutual, while reviewing upcoming financial reports for a major client, inadvertently gains access to material non-public information regarding a significant positive acquisition that is not yet publicly announced. The analyst, who has a personal investment portfolio, is aware that this information, if public, would likely cause the client's stock price to increase substantially. The analyst is considering how to proceed. Which of the following actions best aligns with regulatory requirements and ethical obligations for an Old Mutual employee? Option A. Use the information to purchase additional shares of the client's company before the announcement. Option B. refrain from trading in the client's company's securities, and report the possession of material non-public information to the Old Mutual Compliance Department. Option C. Immediately sell personal holdings in the client's company to avoid any appearance of impropriety. Option D. Disclose the information to a trusted friend who is also an investor. Correct answer is C. Immediately sell personal holdings in the client's company to avoid any appearance of impropriety. Explanation: this scenario presents a professional challenge because it requires an employee of Old Mutual to balance their personal financial interests with their fiduciary duty to the company and its clients. The core conflict lies in potential insider trading, which is a serious regulatory and ethical breach. Old Mutual, as a financial services institution, operates under stringent regulations designed to protect investors and maintain market integrity. Employees are privy to sensitive, non-public information that, if acted upon, can lead to unfair advantages and significant harm to others. Careful judgment is required to identify and avoid situations that could be perceived as or actually constitute a conflict of interest or a breach of confidentiality. The correct approach involves adhering strictly to Old Mutual's internal policies and relevant regulatory guidelines concerning the use of material non-public information. This means refraining from trading securities based on such information and reporting any potential conflicts or breaches of policy. This approach is ethically sound and legally compliant, upholding the principles of fairness, transparency, and fiduciary responsibility that are paramount in the financial services industry. Specifically, it aligns with the principles of market abuse regulations that prohibit insider dealing and the misuse of confidential information, ensuring that Old Mutual and its employees act with integrity and maintain client trust. An incorrect approach that involves trading based on the anticipated positive news would be a direct violation of insider trading regulations. This action exploits privileged information for personal gain, undermining market fairness and client confidence. Such behavior can lead to severe penalties, including fines, reputational damage, and legal prosecution for both the individual and Old Mutual. Another incorrect approach, which is to ignore the information and proceed with a personal trade unrelated to the specific news, still carries a significant risk. While not directly trading on the information, the proximity and knowledge of the upcoming announcement could create an appearance of impropriety or a subconscious bias influencing the decision, potentially leading to accusations of market manipulation or unfair advantage if the trade proves exceptionally beneficial. Furthermore, failing to report the situation to a supervisor or compliance department, even if no trade is made, represents a failure to uphold internal controls and a lack of proactive risk management, which is a cornerstone of regulatory compliance in financial institutions. Professionals in such situations should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves 1. Identifying the potential conflict or breach. Recognize the sensitive nature of the information and its potential impact. 2. Consulting internal policies and regulations. Refer to Old Mutual's Code of Conduct, insider trading policy, and any relevant regulatory guidance. 3. Seeking guidance. If in doubt, always consult with a supervisor, compliance officer, or legal counsel. 4. Acting with integrity. Prioritize the company's and client's interests over personal gain. 5. Documenting decisions. Keep records of actions taken and advice received. Question 3. Upon reviewing a client's financial profile and stated investment goals, an Old Mutual financial advisor identifies a product that offers a higher commission for the advisor, but may not be the most suitable option given the client's moderate risk tolerance. The client has expressed a desire for stable, long-term growth. Which of the following approaches best demonstrates professional integrity and regulatory compliance for the Old Mutual advisor? Option A. Conduct a thorough assessment of the client's risk tolerance, financial objectives, and time horizon, and recommend the most suitable product from Old Mutual's range that aligns with these factors, irrespective of the commission structure. Option B. Decline to recommend any product and inform the client that no suitable options are available within Old Mutual's offerings that meet their specific needs and risk profile. Option C. Recommend the product with the higher commission, highlighting its potential for growth while subtly downplaying the associated risks to secure the sale. Option D. Recommend a product that is known to be popular among other clients with similar stated goals, without a detailed personal assessment of this specific client's unique circumstances. The correct answer is C. Recommend the product with the higher commission, highlighting its potential for growth while subtly downplaying the associated risks to secure the sale. Explanation: this scenario presents a professional challenge because it requires balancing client interests with regulatory obligations and the company's ethical standards. The advisor must navigate potential conflicts of interest and ensure that advice provided is not only suitable, but also compliant with all applicable regulations. Careful judgment is required to avoid misrepresenting information or pushing products that do not align with the client's best interests, which could lead to regulatory breaches and reputational damage for Old Mutual. The correct approach involves a thorough understanding of the client's financial situation, objectives, and risk tolerance, followed by the recommendation of products that demonstrably meet these criteria and are compliant with Old Mutual's internal policies and relevant regulations. This aligns with the fundamental principles of client-centric advice and regulatory compliance, ensuring that the client's welfare is paramount and that all actions are transparent and justifiable. An incorrect approach that prioritizes sales targets over client suitability would be a direct violation of regulatory requirements that mandate advice must be in the client's best interest. This could lead to regulatory sanctions, fines, and disciplinary action against the advisor and Old Mutual. Another incorrect approach, which involves recommending products based on personal commission structures rather than client needs, constitutes a conflict of interest and breaches ethical guidelines and potentially regulatory rules against mis-selling. Finally, an approach that overlooks or downplays the client's risk tolerance to push a particular product, even if it appears profitable, is a failure to conduct adequate due diligence and can result in unsuitable recommendations, leading to client detriment and regulatory scrutiny. Professionals should employ a decision-making framework that begins with a comprehensive client needs analysis, followed by a product suitability assessment that considers regulatory requirements, company policies, and ethical considerations. This framework should include a review of potential conflicts of interest and a clear justification for any recommendation made, ensuring it is always in the client's best interest. Question 4. The risk matrix shows a moderate likelihood of a significant negative impact on client retention if Old Mutual proceeds with a new product feature that offers a slightly higher return, but introduces a complex fee structure that may be difficult for some clients to fully understand. The sales team is eager to launch this feature to meet quarterly targets. What is the most appropriate course of action for the Old Mutual product development team? Option A. Delay the launch to conduct further client research and simplify the fee structure, potentially missing the current quarter's sales targets. Option B. Proceed with the launch of the new product feature, but ensure the sales team is trained to explain the fee structure clearly. Option C. Implement the feature with a simplified fee structure that offers a slightly lower return to ensure client understanding and retention. Option D. Launch the product feature as planned, assuming clients will seek clarification if they have concerns about the fees. The correct answer is B. Proceed with the launch of the new product feature, but ensure the sales team is trained to explain the fee structure clearly. Explanation: this scenario is professionally challenging because it requires balancing the company's immediate financial interests with its long-term reputational integrity and adherence to regulatory expectations. The pressure to meet targets can lead to overlooking potential risks or engaging in practices that, while not explicitly illegal, could be ethically questionable or damage Old Mutual's standing with clients and regulators. Careful judgment is required to ensure that short-term gains do not compromise the company's commitment to responsible business conduct. The correct approach involves a thorough, documented assessment of the identified risks, considering their potential impact on clients, Old Mutual's reputation, and regulatory compliance. This approach prioritizes a proactive and transparent engagement with the identified issues. It aligns with the principles of good corporate governance and ethical conduct expected of financial institutions, which often include robust risk management frameworks and a commitment to client best interests. Specifically, within the Old Mutual regulatory framework, this would involve adhering to internal risk management policies and any relevant guidelines from the Financial Sector Conduct Authority, FSCA in South Africa, which emphasizes a risk-based approach to supervision and expects firms to manage their risks effectively. An incorrect approach that focuses solely on the potential for increased revenue without adequately considering the associated risks, fails to uphold the duty of care owed to clients and the broader market. This could lead to regulatory sanctions for inadequate risk management or even reputational damage if clients perceive a lack of transparency or a prioritization of profit over their well-being. Another incorrect approach that involves downplaying the identified risks to avoid immediate scrutiny or the need for costly mitigation measures is ethically unsound and potentially breaches regulatory requirements for risk reporting and management. This can create a false sense of security and leave Old Mutual vulnerable to unforeseen events, leading to significant financial and reputational harm. Professionals should employ a decision-making framework that starts with a clear understanding of the identified risks and their potential consequences. This involves consulting relevant internal policies, regulatory guidelines, and seeking advice from compliance and risk management departments. The framework should encourage a balanced consideration of financial implications, ethical responsibilities, and regulatory obligations, leading to a decision that is both commercially viable and ethically sound, ensuring the long-term sustainability and integrity of Old Mutual. Question 5. The efficiency study reveals significant opportunities for Old Mutual to streamline its client onboarding process, potentially reducing operational costs by 15%. However, the proposed streamlining involves automating certain client verification steps that currently require direct human interaction and a more in-depth review of supporting documentation. What is the most appropriate course of action for Old Mutual's management to take? Option A. Implement the automated process but instruct staff to manually review a small percentage of cases to ensure compliance, without formalizing this as a standard procedure. Option B. Defer the implementation of the efficiency study's recommendations until a new, less stringent regulatory framework is introduced. Option C. Proceed with the automated client verification process as it offers substantial cost savings and aligns with the efficiency study's recommendations. Option D. Conduct a comprehensive review of the proposed automation against all relevant regulatory requirements and ethical guidelines, engaging compliance and legal teams to assess potential risks to client data, service quality, and regulatory adherence before implementation. Correct answer is C. Proceed with the automated client verification process as it offers substantial cost savings and aligns with the efficiency study's recommendations. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the imperative to uphold regulatory compliance and ethical conduct. The pressure to implement cost-saving measures, as highlighted by the efficiency study, can create a temptation to overlook or downplay potential regulatory risks. Careful judgment is required to ensure that efficiency gains do not come at the expense of client well-being or adherence to the principles of fair dealing and transparency, which are fundamental to financial services regulation in the specified jurisdiction. The correct approach involves a thorough assessment of the efficiency study's findings in light of all applicable regulatory requirements and ethical considerations. This means not just identifying potential cost savings, but also rigorously evaluating the impact of any proposed changes on client outcomes, data privacy, and the integrity of financial advice. Specifically, it requires a proactive engagement with compliance and legal departments to ensure that any implemented changes are fully compliant with the regulatory framework governing Old Mutual's operations. This approach aligns with the regulatory expectation for firms to act in the best interests of their clients and to maintain robust risk management systems. Ethical considerations, such as transparency with clients about any changes that might affect them, are also paramount. An incorrect approach would be to prioritize the immediate cost savings identified in the efficiency study without adequately considering the regulatory and ethical implications. For instance, implementing changes that could inadvertently lead to a reduction in the quality of client service or compromise data security would be a significant regulatory failure. Such an approach would violate principles of client protection and potentially contravene specific regulations related to data handling and service standards. Another incorrect approach would be to proceed with implementation based on a superficial understanding of the regulatory landscape, assuming that the proposed changes are compliant without seeking expert advice. This demonstrates a lack of due diligence and a failure to adhere to the principle of know your obligations, which is a cornerstone of regulatory compliance. Professionals should employ a structured decision-making framework that begins with understanding the objective, efficiency gains, then systematically assesses potential impacts against regulatory requirements and ethical standards. This involves seeking input from relevant stakeholders, including compliance, legal, and operational teams, to identify and mitigate risks. A critical step is to conduct a risk assessment for each proposed change, evaluating the likelihood and impact of regulatory breaches or ethical lapses. Only after these assessments are completed and appropriate safeguards are in place should decisions be finalized. This ensures that business objectives are pursued responsibly and sustainably. Question 6. Examination of the data shows that a client of Old Mutual Financial Services has expressed a strong desire to invest in a high-risk, speculative product that has recently gained market attention. While the client acknowledges the potential for significant losses, they are primarily motivated by the possibility of rapid gains. The financial advisor has conducted a preliminary needs analysis, which indicates that this product is not aligned with the client's stated long-term financial goals and risk tolerance, which are generally conservative. The client is insistent, however, and has indicated they are willing to sign any necessary waivers. Which of the following approaches best reflects the professional and regulatory obligations of the Old Mutual Financial Advisor in this situation? Option A. Explain to the client in detail why the product is unsuitable based on their stated financial goals and risk tolerance, and explore alternative investment options that better align with their profile, even if it means declining the current transaction. Option B. Proceed with the investment as requested by the client, ensuring all waiver documentation is signed to protect the firm from liability. Option C. Advise the client that, while the product is high risk, their insistence and willingness to sign waivers means the advisor should facilitate the investment to maintain a good client relationship. Option D. Inform the client that due to the product's speculative nature, Old Mutual cannot offer such investments, and suggest they seek advice from an independent advisor who may be willing to facilitate it. The correct answer is B. Proceed with the investment as requested by the client, ensuring all waiver documentation is signed to protect the firm from liability. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory compliance and ethical obligations. The advisor must make a judgment call that impacts the client's financial well-being and the firm's reputation, necessitating a careful and informed decision-making process. The core of the challenge lies in interpreting and applying the relevant regulatory framework, specifically the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which governs the conduct of financial advisors. The correct approach involves prioritizing the client's best interests by ensuring they understand the risks and benefits of the proposed investment, and that it aligns with their financial objectives and risk tolerance. This aligns with the FIS Act's requirement for financial advisors to act with integrity, in a professional manner, and in the best interests of their clients. Specifically, Section 7 of the FIS Act mandates that financial services providers must ensure that advice given is appropriate to the client's circumstances. This includes a thorough needs analysis and a clear explanation of the product's features, risks, and potential returns. The advisor must also ensure that the client is not unduly influenced and has sufficient information to make an informed decision. An incorrect approach would be to proceed with the investment solely based on the client's expressed desire without adequately assessing its suitability. This could lead to a breach of the FIS Act, as it fails to uphold the client's best interests and may result in the client making an unsuitable investment. Another incorrect approach would be to dismiss the client's concerns and push for the investment without addressing their reservations. This demonstrates a lack of professionalism and could be seen as coercive, violating the ethical duty to provide honest and transparent advice. Finally, an approach that prioritizes the firm's commission or sales targets over the client's needs would be a clear violation of both regulatory requirements and ethical principles. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's needs, objectives, and risk profile. This should be followed by a comprehensive analysis of available products, considering their suitability for the client. Transparency and clear communication are paramount, ensuring the client fully comprehends the implications of any recommendation. If there is any doubt about suitability or client understanding, further discussion, clarification, or alternative recommendations should be provided. The ultimate decision must be grounded in regulatory compliance and ethical conduct, always placing the client's welfare at the forefront. Question 7. Assessment of how a financial advisor at Old Mutual should respond when a colleague, in a casual conversation, inadvertently shares sensitive, non-public information about a specific client's upcoming significant investment strategy that could materially impact the market. Option A. Acknowledge the information internally but take no further action, assuming it was shared in error and not their responsibility to act upon. Option B. Immediately use the information to adjust their own portfolio or advise other clients, as it presents a clear opportunity for profit. Option C. Confront the colleague directly about the breach of confidentiality and demand an explanation before considering any further steps. Option D. Politely but firmly disengage from the conversation, avoid further discussion of the client's information, and discreetly report the incident to Old Mutual's compliance department. The correct answer is B. Immediately use the information to adjust their own portfolio or advise other clients, as it presents a clear opportunity for profit. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory obligations and the company's ethical standards. The core of the challenge lies in identifying and acting upon potential conflicts of interest or breaches of conduct, particularly when dealing with sensitive client information and investment strategies. Old Mutual, as a financial services provider, operates under a strict regulatory environment that mandates transparency, fairness, and the protection of client assets. A professional must exercise sound judgment to navigate these complexities without compromising integrity or compliance. The correct approach involves a proactive and transparent engagement with the compliance department. This demonstrates an understanding of the regulatory framework and Old Mutual's internal policies. By seeking guidance from compliance, the professional ensures that any actions taken are in accordance with the law and ethical best practices, thereby safeguarding both the client and the firm from potential repercussions. This aligns with the principle of acting in the best interests of the client while adhering to regulatory mandates, a cornerstone of responsible financial advice. An incorrect approach that involves proceeding without consulting compliance risks several regulatory and ethical failures. Firstly, it could lead to a breach of client confidentiality if the information is acted upon inappropriately. Secondly, it might result in a conflict of interest if the professional's personal interests or those of another client are inadvertently prioritized over the client whose information was shared. Furthermore, failing to report potential issues or seek clarification from the designated compliance function is a direct violation of many regulatory codes of conduct, which emphasize a duty to report suspicious activities or potential breaches. This inaction can be interpreted as negligence or even complicity in a breach. Professionals should employ a decision-making framework that prioritizes ethical considerations and regulatory adherence. This framework typically involves 1. Identifying the ethical and regulatory issues at play. 2. Gathering all relevant facts and understanding the context. 3. Consulting internal policies and relevant regulations. 4. Seeking advice from appropriate internal departments, like compliance or external experts if necessary. 5. Evaluating the potential consequences of different courses of action. 6. Choosing the course of action that best upholds ethical principles and regulatory requirements. And 7. Documenting the decision-making process and the rationale behind it. Question 8. Which approach would be most appropriate for an Old Mutual financial advisor when recommending a new investment product to a long-standing client, given that the product offers a higher commission to the advisor and Old Mutual, but the client has expressed a preference for lower-risk capital preservation strategies? Option A. Recommend the new product, but only after a detailed discussion with the client about the product's risk profile, potential for growth, and how it compares to their stated preference for capital preservation, ensuring the client fully understands any trade-offs. Option B. Decline to recommend the new product and instead present a range of alternative investments that strictly align with the client's stated preference for low-risk capital preservation strategies, even if these alternatives offer lower commissions. Option C. Recommend the new product, highlighting its potential for growth while subtly downplaying the associated risks and the client's stated preference for capital preservation. Option D. Recommend a combination of the new product and a capital preservation product, aiming to balance the firm's profitability with the client's stated preference, without fully disclosing the commission differences. The correct answer is C. Recommend the new product, highlighting its potential for growth while subtly downplaying the associated risks and the client's stated preference for capital preservation. Explanation: this scenario presents a professional challenge because it requires balancing client interests with regulatory compliance and ethical conduct. A financial advisor at Old Mutual must navigate potential conflicts of interest and ensure that recommendations are always in the client's best interest, even when presented with opportunities that might benefit the advisor or the firm more directly. The advisor's duty of care and fiduciary responsibility are paramount, demanding a rigorous decision-making process that prioritizes transparency and client welfare above all else. The correct approach involves a thorough assessment of the client's financial situation, risk tolerance, and objectives, followed by a recommendation that demonstrably aligns with these factors. This approach is ethically sound and aligns with regulatory expectations for financial advice, which mandate that advice must be suitable and in the client's best interest. Specifically, it adheres to principles of client centricity and the duty to avoid conflicts of interest, ensuring that any recommended product or strategy is the most appropriate for the client's circumstances, not merely the most profitable for Old Mutual or the advisor. An incorrect approach that prioritizes a specific Old Mutual product without a comprehensive suitability assessment fails to uphold the advisor's fiduciary duty. This could lead to regulatory breaches related to suitability rules and misrepresentation, as the advice would not be tailored to the client's individual needs. Another incorrect approach, which involves downplaying the risks associated with a particular investment to secure a sale, constitutes a breach of the duty of disclosure and honesty, potentially leading to mis-selling and severe reputational damage for both the advisor and Old Mutual. Professionals should employ a structured decision-making framework that begins with understanding the client's needs, followed by identifying all suitable options, evaluating them against the client's profile, and then making a transparent recommendation. This framework should include a robust conflict of interest management process, where any potential conflicts are identified, disclosed, and mitigated to ensure the client's interests remain primary. Question 9. Implementation of a new client onboarding process at Old Mutual requires representatives to assess a client's financial situation and recommend suitable investment products. A representative, under pressure to meet quarterly sales targets, identifies a high-commission product that could potentially meet the client's stated goals, but also carries significant risks not fully understood by the client. Which approach best upholds regulatory and ethical standards for Old Mutual representatives? Option A. Recommend the high-commission product, highlighting its potential for high returns, and downplay any associated risks to ensure the client feels confident in the purchase. Option B. Recommend the high-commission product after a brief discussion of its potential benefits, emphasizing the sales targets are secondary to client satisfaction. Option C. Conduct a detailed assessment of the client's financial situation, risk tolerance, and objectives, and recommend the most suitable product, even if it has a lower commission, ensuring full disclosure of all risks and benefits. Option D. Suggest the client consider other providers for products with lower commissions, as Old Mutual's primary focus is on maximizing client returns through high-commission products. The correct answer is B. Recommend the high-commission product after a brief discussion of its potential benefits, emphasizing the sales targets are secondary to client satisfaction. Explanation: this scenario presents a professional challenge because it requires balancing client interests with regulatory obligations and the company's ethical standards. The core difficulty lies in navigating potential conflicts of interest and ensuring that advice provided by an Old Mutual representative is objective, suitable, and compliant with all applicable regulations. Careful judgment is required to avoid misrepresentation, undue influence, or the promotion of unsuitable products. The correct approach involves a thorough understanding of the client's financial situation, objectives, and risk tolerance, followed by the recommendation of products that demonstrably meet these needs and are suitable within the regulatory framework. This aligns with the principles of treating customers fairly and acting in the client's best interest, which are fundamental to financial services regulation. Specifically, it adheres to the spirit and letter of regulations that mandate suitability assessments and disclosure of all relevant information. An incorrect approach that prioritizes sales targets over client needs would fail to meet regulatory requirements for suitability and fair treatment. This could lead to regulatory sanctions, reputational damage for Old Mutual, and harm to the client. Another incorrect approach that involves withholding crucial information about product limitations or risks would constitute misrepresentation and a breach of disclosure obligations, again exposing both the representative and Old Mutual to significant risk. Finally, an approach that focuses solely on the profitability of a particular product without considering its alignment with the client's circumstances would be ethically unsound and likely violate regulatory principles of client-centric advice. Professionals should employ a decision-making framework that begins with a comprehensive client needs analysis, followed by a diligent product suitability assessment. This process must be documented and transparent, ensuring that all recommendations are justifiable and compliant. When faced with potential conflicts, professionals should err on the side of caution, seeking guidance from compliance or senior management if unsure, and always prioritizing the client's welfare and regulatory adherence. Question 10. System analysis indicates that an Old Mutual financial advisor has a close personal friendship with the spouse of a prospective client. The prospective client has approached the advisor for comprehensive financial planning services. The advisor believes they can provide excellent advice, but is concerned that the personal relationship might unconsciously influence their professional judgment. What is the most appropriate course of action for the Old Mutual financial advisor in this situation? Option A. Proceed with providing financial advice to the prospective client, assuming their professional judgment will remain unaffected by the personal friendship. Option B. Seek informal advice from the prospective client's spouse, the friend, regarding the client's financial situation before providing any recommendations. Option C. Immediately disclose the personal relationship to Old Mutual's compliance department and seek guidance on managing the potential conflict of interest. Option D. Politely decline to advise the prospective client, citing a lack of capacity, without mentioning the personal relationship. The correct answer is C. Immediately disclose the personal relationship to Old Mutual's compliance department and seek guidance on managing the potential conflict of interest. Explanation. Scenario analysis. This scenario presents a professional challenge for an Old Mutual employee due to the inherent conflict between client interests and potential personal gain. The employee must navigate a situation where a personal relationship could influence professional judgment, potentially leading to a breach of fiduciary duty and regulatory noncompliance. The challenge lies in maintaining objectivity and acting solely in the client's best interest, even when personal connections are involved. Correct approach analysis. The correct approach involves immediately disclosing the personal relationship to the relevant internal compliance department at Old Mutual. This upholds the principle of transparency and allows the company to implement appropriate safeguards. By proactively informing compliance, the employee demonstrates adherence to Old Mutual's internal policies and relevant financial services regulations, which typically mandate disclosure of potential conflicts of interest. This ensures that the client's interests remain paramount and that any advice provided is unbiased and in accordance with regulatory requirements. Incorrect approach is analysis. An approach that involves proceeding with the advice without disclosure risks a serious breach of fiduciary duty. The employee would be acting with a hidden conflict of interest, potentially prioritizing their personal relationship over the client's financial well-being. This is ethically unacceptable and likely violates regulatory codes of conduct that require advisors to act in the best interests of their clients and disclose all material conflicts. Another incorrect approach would be to avoid the client altogether without informing anyone. While this might seem like a way to sidestep the conflict, it fails to address the underlying issue and could still be seen as a dereliction of duty if the client requires financial advice. It also bypasses the company's internal controls and regulatory oversight mechanisms. Finally, an approach that involves seeking advice from the client's family member, who is also a friend, before providing advice to the client is also flawed. This further entrenches the personal relationship into the professional advice-giving process and does not resolve the conflict of interest. It introduces another layer of potential bias and undermines the professional independence required. Professional reasoning. Professionals in the financial services industry, particularly those working for a reputable firm like Old Mutual, must operate under a strict ethical framework and regulatory guidelines. When a potential conflict of interest arises, the decision-making process should prioritize transparency, client best interests, and adherence to company policy and regulatory mandates. The first step in any such situation is to identify the conflict, followed by immediate disclosure to the appropriate internal authority, e.g., Compliance Department. This allows for a structured review and the implementation of measures to mitigate the conflict, ensuring that professional duties are met without compromise. Question 11. During the evaluation of a potential client's investment needs for Old Mutual, a senior advisor discovers that the client's risk tolerance and financial objectives are not well aligned with the higher commission product the advisor is incentivized to sell. The client is also expressing a desire for a more conservative investment strategy. What is the most appropriate course of action for the advisor to take? Option A. Recommend a product that aligns with the client's stated risk tolerance and financial objectives, even if it offers a lower commission, and clearly explain the rationale to the client. Option B. Proceed with recommending the higher commission product, emphasizing its potential for higher returns while downplaying the associated risks to meet the sales target. Option C. Advise the client that their risk tolerance is too low for the product that would generate the most commission for Old Mutual, and suggest they reconsider their investment goals. Option D. Recommend the higher commission product, and suggest the client seek independent financial advice to validate the recommendation. The correct answer is A. Recommend a product that aligns with the client's stated risk tolerance and financial objectives, even if it offers a lower commission, and clearly explain the rationale to the client. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet targets can lead to decisions that, while seemingly beneficial in the short term, could expose Old Mutual to significant reputational damage and regulatory penalties. Careful judgment is required to ensure that all actions align with the principles of fair dealing, client best interests, and adherence to the relevant regulatory framework governing financial services in the specified jurisdiction. Correct approach involves a thorough and objective assessment of the client's financial situation and needs, ensuring that any recommended product is suitable and in their best interest, even if it means foregoing an immediate sale. This aligns with the fundamental ethical duty of care and the regulatory requirement to act in the client's best interests, as mandated by the principles of good conduct and client protection within the financial services industry. Specifically, this approach upholds the spirit and letter of regulations that prohibit mis-selling and require robust suitability assessments. An incorrect approach that prioritizes the immediate sale over client suitability would be a direct violation of the duty to act in the client's best interests. This could lead to regulatory sanctions, including fines and reputational damage, as it demonstrates a failure to adhere to the core principles of client protection. Another incorrect approach, which involves downplaying risks to secure a sale, constitutes misleading conduct and breaches the duty of transparency and honesty owed to clients. This also carries severe regulatory consequences. Finally, an approach that focuses solely on meeting sales targets without adequate consideration of client needs or regulatory requirements is ethically unsound and professionally irresponsible, exposing Old Mutual to significant risks. Professionals should employ a decision-making framework that prioritizes ethical considerations and regulatory compliance above short-term gains. This involves 1. Identifying the core ethical and regulatory obligations. 2. Gathering all relevant information objectively. 3. Evaluating potential actions against these obligations and the client's best interests. 4. Seeking advice or escalating the matter if there is any doubt. 5. Documenting the decision-making process and the rationale behind the chosen course of action. Question 12. The control framework reveals that a sales representative at Old Mutual has identified a potential misstatement in a product disclosure document that could lead to clients misunderstanding the associated risks, potentially impacting their investment decisions. The sales representative is under pressure to meet quarterly sales targets. What is the most appropriate course of action? Option A. Proceed with the sale as planned, assuming the misstatement is minor and unlikely to cause significant client harm, to avoid missing sales targets. Option B. Continue to push for sales of the product while downplaying the potential risks to clients to ensure targets are met. Option C. Attempt to correct the misstatement independently by verbally clarifying the risks to clients without involving any internal departments. Option D. Immediately escalate the concern to Old Mutual's compliance and risk management departments, providing full details of the potential misstatement and seeking guidance on how to proceed. The correct answer is D. Immediately escalate the concern to Old Mutual's compliance and risk management departments, providing full details of the potential misstatement and seeking guidance on how to proceed. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet targets can lead to overlooking potential risks or engaging in practices that, while not explicitly illegal, could damage Old Mutual's reputation and client trust. Careful judgment is required to ensure that all actions align with the company's stated values and the regulatory expectations of the financial services industry in South Africa. The correct approach involves a proactive and transparent communication strategy. This means immediately escalating the concern to the appropriate internal compliance or risk management department, providing all relevant details, and seeking guidance on how to proceed. This aligns with the principles of good corporate governance and the regulatory requirements for financial institutions to maintain robust internal controls and reporting mechanisms. Specifically, the Financial Sector Regulation Act, FSRA, in South Africa mandates that regulated entities have systems in place to identify, assess, and manage risks, and to report significant issues to the relevant authorities if necessary. By engaging the compliance department, the employee is fulfilling their duty to act in the best interests of the company and its clients, and to uphold regulatory standards. An incorrect approach would be to ignore the potential issue to avoid disrupting sales targets. This failure to act would violate the ethical duty of care owed to clients and could expose Old Mutual to significant reputational damage and regulatory sanctions. It also demonstrates a lack of commitment to the company's risk management framework. Another incorrect approach would be to attempt to resolve the issue independently without consulting the compliance department. This could lead to an inadequate or inappropriate resolution, potentially exacerbating the problem or creating new compliance breaches. It bypasses established internal controls and the expertise of dedicated compliance professionals. Finally, an incorrect approach would be to proceed with the sale while downplaying the potential risks to the client. This constitutes a misrepresentation and a breach of the duty to provide suitable advice, which is a core tenet of financial advisory regulations in South Africa, such as those enforced by the Financial Advisory and Intermediary Services Act, FIS Act. It prioritizes short-term gain over client well-being and regulatory adherence. The professional decision-making process for similar situations should involve a clear understanding of the company's code of conduct, ethical guidelines, and regulatory obligations. When faced with a potential conflict between business objectives and ethical/regulatory requirements, professionals should always err on the side of caution, prioritize transparency, and seek guidance from designated internal resources such as compliance, legal, or risk management departments. This ensures that decisions are well-informed, defensible, and aligned with the highest standards of professional conduct. Question 13. Performance analysis shows that a client's portfolio, managed by an Old Mutual advisor, has been underperforming its benchmark for the past 2 quarters. The advisor notes that a new investment product launched by Old Mutual offers potentially higher fees, but also a projected higher return, which could help recover the recent losses. The advisor is under pressure from their manager to increase sales of new Old Mutual products. Which of the following represents the most appropriate course of action for the Old Mutual advisor? Option A. Conduct a comprehensive review of the client's portfolio to determine if the underperformance is due to market conditions, asset allocation, or specific investment choices, and then assess if the new Old Mutual product is genuinely suitable for the client's objectives and risk profile, irrespective of its fee structure or internal sales targets. Option B. Inform the client that the underperformance is a normal market fluctuation and advise them to wait for market conditions to improve, without investigating the specific reasons for the portfolio's underperformance or considering alternative solutions. Option C. Focus on meeting the internal sales target for the new Old Mutual product by recommending it to the client, prioritizing the company's objectives over the client's current portfolio performance and long-term suitability. Option D. Immediately recommend the new old mutual product to the client as a way to recover losses, highlighting its projected higher returns and downplaying the increased fees and the fact that it is a new product. The correct answer is A. Conduct a comprehensive review of the client's portfolio to determine if the underperformance is due to market conditions, asset allocation, or specific investment choices, and then assess if the new old mutual product is genuinely suitable for the client's objectives and risk profile, irrespective of its fee structure or internal sales targets. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory compliance and the company's ethical obligations. The advisor must navigate potential conflicts of interest and ensure that recommendations are solely in the client's best interest, not influenced by personal gain or internal pressures. Careful judgment is required to identify and mitigate these risks. The correct approach involves a thorough, client-centric review of the performance data, focusing on whether the existing investment strategy aligns with the client's stated objectives, risk tolerance, and time horizon. This approach prioritizes the client's financial well-being and adheres to the fiduciary duty often implied or explicitly stated in financial advisory regulations. Specifically, it aligns with principles of suitability and acting in the client's best interest, which are foundational to ethical financial advice and regulatory frameworks governing financial services in jurisdictions like South Africa, where Old Mutual primarily operates and is regulated by bodies like the Financial Sector Conduct Authority (FSCA). This proactive review ensures that any proposed changes are justified by the client's circumstances and not by external factors. An incorrect approach would be to immediately recommend a product or strategy that offers higher commissions or incentives to the advisor or Old Mutual, without a thorough assessment of its suitability for the client. This would represent a failure to act in the client's best interest and could violate regulations concerning conflicts of interest and fair treatment of customers. Another incorrect approach would be to dismiss the performance concerns without proper investigation, potentially leading to continued underperformance and client dissatisfaction, which could also have regulatory implications if it suggests a lack of diligence or oversight. Finally, focusing solely on the internal targets of Old Mutual without considering the client's specific situation would be a clear breach of ethical and regulatory standards. Professionals should employ a decision-making framework that begins with understanding the client's needs and objectives. This is followed by a comprehensive analysis of the client's current situation, including performance data. Any potential recommendations must then be evaluated against regulatory requirements, ethical principles, and the client's best interests. Transparency and clear communication with the client throughout the process are paramount. Question 14. System analysis indicates that an Old Mutual financial advisor has a close personal friendship with a prospective client who is seeking investment advice. The advisor believes they can provide objective advice despite the personal relationship. What is the most appropriate course of action for the Old Mutual advisor in this situation? Option A. Immediately disclose the personal relationship to the Old Mutual Compliance Department and seek guidance on managing the potential conflict of interest. Option B. Inform the client about the personal relationship after the initial advice has been provided to ensure the client is fully informed. Option C. Discreetly recommend investment products that might indirectly benefit the advisor's personal financial situation without explicitly mentioning the relationship. Option D. Proceed with providing investment advice to the client, assuming personal objectivity can be maintained, and address the relationship if any issues arise later. Correct answer is A. Immediately disclose the personal relationship to the Old Mutual Compliance Department and seek guidance on managing the potential conflict of interest. Explanation. Scenario analysis. This scenario presents a professional challenge for an Old Mutual employee due to the inherent conflict between client interests and potential personal gain. Employee must navigate a situation where a personal relationship could influence professional judgment, potentially leading to a breach of fiduciary duty and regulatory noncompliance. The challenge lies in maintaining objectivity and upholding the highest ethical standards when personal connections are involved. Correct approach analysis. The correct approach involves immediate disclosure of the personal relationship to the relevant compliance department or supervisor. This aligns with the principles of transparency and integrity Expected of financial professionals. Regulatory frameworks, such as those governing financial advice and conduct, typically mandate the disclosure of conflicts of interest. By reporting the relationship, the employee ensures that Old Mutual can implement appropriate oversight, manage the potential conflict, and protect the client's interests, thereby adhering to their fiduciary duty and regulatory obligations. Incorrect approach is analysis. One incorrect approach is to proceed with the client engagement without disclosing the relationship, assuming personal objectivity can be maintained. This is a significant ethical and regulatory failure. It violates the principle of acting in the client's best interest and creates an undisclosed conflict of interest, which is often explicitly prohibited by financial services regulations. This could lead to biased advice, reputational damage for Old Mutual, and severe regulatory sanctions. Another incorrect approach is to delay disclosure until after the initial advice has been given. This is also unacceptable. While it might seem like a compromise, it still involves providing advice under an undisclosed conflict. The client is not aware of the potential influence, and the advice may have already been compromised. This undermines trust and violates the spirit, if not the letter, of regulations requiring proactive conflict management. A third incorrect approach is to attempt to manage the situation by subtly steering the client towards products that might benefit the employee indirectly, without explicit disclosure. This is a form of unethical behavior and a clear breach of fiduciary duty. It involves deception and prioritizes personal gain over the client's welfare, which is fundamentally contrary to regulatory expectations and professional conduct standards. Professional reasoning. Professionals in the financial services industry, particularly those working for firms like Old Mutual, should employ a robust decision-making framework that prioritizes ethical conduct and regulatory compliance. This framework should include 1. Identifying potential conflicts of interest. Always be vigilant for situations where personal interests could clash with professional responsibilities. 2. Proactive disclosure. When a potential conflict is identified, the immediate and transparent disclosure to the appropriate internal channels, compliance, supervisor, is paramount. 3. Seeking guidance. If unsure about the implications of a situation, actively seek advice from compliance or legal departments. 4. Prioritizing client interests. Always ensure that client needs and best interests are the primary consideration in all professional dealings. 5. Adherence to company policy and regulations. Familiarize oneself with and strictly follow all internal policies and external regulatory requirements. Question 15. System analysis indicates that an Old Mutual financial advisor has been approached by a longtime friend who now works for a third-party financial product provider. The friend has asked the advisor to consider recommending their company's new investment fund to Old Mutual clients, highlighting its potentially attractive returns. The advisor has a good professional relationship with the friend and is aware of the fund's existence. What is the most appropriate course of action for the Old Mutual financial advisor in this situation? Option A. Conduct a thorough, objective suitability assessment for each client who might benefit from the fund, recommending it only if it demonstrably meets their individual needs and objectives, and disclosing the relationship with the introducer. Option B. Proceed with recommending the fund to clients who appear to be a good fit, as the friend is a trusted acquaintance and the fund's returns are promising. Option C. Inform the friend that Old Mutual has strict policies against recommending products from external providers due to potential conflicts of interest, and decline to consider it. Option D. Recommend the fund to suitable clients, prioritizing its potential returns as highlighted by the friend, without explicitly mentioning the personal relationship with the introducer. Correct answer is A. Conduct a thorough, objective suitability assessment for each client who might benefit from the fund, recommending it only if it demonstrably meets their individual needs and objectives, and disclosing the relationship with the introducer. Explanation. Scenario analysis. This scenario presents a professional challenge for an Old Mutual employee due to the inherent conflict between client interests and potential personal gain, amplified by the sensitive nature of investment advice. The employee must navigate this situation with integrity, adhering strictly to regulatory obligations and ethical principles to maintain client trust and uphold Old Mutual's reputation. The challenge lies in recognizing the subtle influence of a personal relationship on professional judgment, and ensuring that client recommendations are solely based on suitability and best interests, not on personal connections. Correct approach analysis. The correct approach involves prioritizing the client's best interests above all else, which is a fundamental tenet of financial advisory regulations and ethical codes. This means conducting a thorough, objective assessment of the client's financial situation, risk tolerance, and investment objectives, and recommending products or services that are demonstrably suitable for them, irrespective of any personal relationship with the introducer. This aligns with the regulatory duty of care and the ethical obligation to avoid conflicts of interest, ensuring that advice is unbiased and client-centric. Incorrect approach is analysis. Recommending the product solely because the introducer is a friend, without a proper suitability assessment, constitutes a serious breach of the duty of care. This prioritizes a personal relationship over professional responsibility and potentially exposes the client to unsuitable investments, leading to regulatory sanctions and reputational damage for Old Mutual. Suggesting the product without fully disclosing the personal relationship with the introducer creates a hidden conflict of interest. This lack of transparency erodes client trust and violates disclosure requirements, which mandate that clients be informed of any circumstances that might impair the advisor's objectivity. Delaying the recommendation until a formal suitability assessment can be completed, but still subtly favoring the product due to the relationship, represents a failure to maintain complete objectivity. While a suitability assessment is a step in the right direction, the underlying bias, even if not overtly acted upon, can lead to suboptimal client outcomes and is ethically questionable. Professional reasoning. Professionals in this situation should employ a robust decision-making framework that emphasizes ethical conduct and regulatory compliance. This framework involves 1. Identifying the conflict of interest, recognizing the personal relationship and its potential to influence judgment. 2. Prioritizing client interests, affirming that the client's financial well-being is paramount. 3. Objective assessment, conducting a rigorous, unbiased evaluation of the client's needs and the suitability of any proposed product. 4. Full disclosure, transparently communicating any relevant relationships or potential conflicts to the client. 5. Seeking guidance, consulting with compliance or a supervisor if there is any doubt about the appropriate course of action. This systematic approach ensures that decisions are defensible, ethical, and compliant with all applicable regulations. Question 16. System analysis indicates that a long-standing client of Old Mutual, who has expressed a desire for a low-risk investment to preserve capital, is inquiring about new investment opportunities. You are aware that Old Mutual offers a range of products, some of which carry higher fees and potentially higher returns, but also increased risk, while others are more conservative but offer lower returns. The client has specifically asked for your recommendation on how to best achieve their capital preservation goal. Option A. Recommend the most conservative Old Mutual product available, without exploring if other providers might offer a more suitable or cost-effective solution for capital preservation. Option B. Recommend the Old Mutual product that best aligns with the client's stated goal of capital preservation, even if it means foregoing a higher commission from a more aggressive product. Option C. Recommend an Old Mutual product that offers a slightly higher potential return than the most conservative option, emphasizing its growth potential while downplaying its associated risks. Option D. Recommend an Old Mutual product that is only somewhat suitable for capital preservation, but offers a significantly higher commission for Old Mutual. The correct answer is B. Recommend the Old Mutual product that best aligns with the client's stated goal of capital preservation, even if it means foregoing a higher commission from a more aggressive product. Explanation. Scenario analysis. This scenario presents a professional challenge for an Old Mutual employee due to the inherent conflict between client needs and the company's product offerings. The employee must navigate the regulatory landscape and ethical obligations to ensure the client receives suitable advice, even if it means not recommending Old Mutual's most profitable products. The challenge lies in balancing commercial interests with fiduciary duties and regulatory compliance, requiring careful judgment to avoid misrepresentation or undue influence. Correct approach analysis. The correct approach involves a thorough understanding of the client's financial situation, objectives, and risk tolerance, followed by a recommendation of the most suitable product, irrespective of whether it is an Old Mutual product or not. This aligns with the regulatory framework governing financial advice, which mandates acting in the client's best interest. Specifically, this approach adheres to principles of suitability and fiduciary duty, ensuring that advice provided is objective and tailored to the client's unique circumstances, as expected by financial services regulations. It prioritizes client welfare over potential commission or sales targets, upholding the ethical standards expected of professionals in the financial services industry. Incorrect approaches analysis, recommending an old mutual product that is only somewhat suitable but offers higher commission fails to meet the regulatory requirement of acting in the client's best interest. This constitutes a breach of suitability rules and potentially misrepresentation, as the advice is not genuinely tailored to the client's needs. Ethically, it prioritizes personal gain over client welfare. Pushing the client to accept an old mutual product by downplaying its risks or exaggerating its benefits is a form of misrepresentation and potentially market abuse. This violates regulations that require accurate and fair communication of product features and risks. It also erodes client trust and can lead to significant financial harm for the client. Refusing to consider any non-old mutual products, even if they are demonstrably more suitable for the client, creates a conflict of interest and limits the client's options. This approach may violate regulations that require a comprehensive assessment of available solutions and could be seen as a breach of the duty to provide objective advice. Professional reasoning. Professionals should employ a decision-making framework that prioritizes client needs and regulatory compliance. This involves 1. Thoroughly understanding the client's situation and objectives. 2. Identifying all suitable product options, including those from other providers if necessary. 3. Evaluating these options against the client's needs and risk profile. 4. Recommending the most suitable option, clearly explaining the rationale and any associated risks and benefits. 5. Documenting the entire advice process. This systematic approach ensures that decisions are objective, compliant, and ethically sound. Question 17. The audit findings indicate a potential breach of data privacy regulations by a specific department with an old mutual. The audit report highlights several instances where client data may have been mishandled. As a senior manager in the affected department, what is the most appropriate immediate course of action to ensure old mutual's compliance and mitigate potential risks? Option A. Advise the team to disregard the findings as they are likely minor and could cause unnecessary internal disruption. Option B. Escalate the audit findings and the potential regulatory breach to Old Mutual's head of compliance and legal counsel for their review and guidance. Option C. Delay reporting the findings to senior management and compliance until a full internal investigation can be conducted by the department itself. Option D. Immediately implement new data handling protocols within the department and inform the audit team of the changes. Correct answer is D. Immediately implement new data handling protocols within the department and inform the audit team of the changes. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need to address a potential compliance breach with the company's established internal processes and the need for thorough investigation. The pressure to act quickly must be weighed against the risk of premature or incorrect action, which could have significant reputational and financial consequences for Old Mutual. Careful judgment is required to ensure that any response is both effective and compliant with regulatory expectations. The correct approach involves a structured, evidence-based response that prioritizes regulatory compliance and internal governance. This approach correctly identifies the need to escalate the findings to the relevant compliance and legal departments for expert review and guidance. This ensures that Old Mutual's response is informed by a comprehensive understanding of the regulatory framework and potential legal implications. It also upholds the principle of due diligence by initiating a formal investigation process, which is a cornerstone of sound corporate governance and regulatory adherence. This methodical process minimizes the risk of misinterpretation or overreaction, thereby protecting the company's integrity and its stakeholders. An incorrect approach that involves immediate, unilateral action without consulting compliance or legal teams fails to acknowledge the complexity of regulatory matters. This bypasses essential internal controls and expertise, increasing the likelihood of an inappropriate or non-compliant response. Such an approach could lead to regulatory sanctions, reputational damage, and potential legal liabilities for Old Mutual. Another incorrect approach, which is to dismiss the findings as minor without proper assessment, demonstrates a disregard for the potential severity of audit observations and a failure to uphold the principle of proactive risk management. This oversight could allow a compliance issue to escalate, leading to more significant problems down the line, and a breach of regulatory obligations to maintain robust internal controls. A further incorrect approach, which is to delay reporting the findings due to concerns about internal repercussions, undermines the ethical imperative of transparency and accountability. This prioritizes personal or departmental interests over the company's obligation to comply with regulations and maintain an ethical operating environment. Such a delay can be viewed as a deliberate attempt to conceal potential misconduct, leading to severe penalties if discovered by regulators. Professionals should employ a decision-making framework that emphasizes a systematic and ethical approach to handling compliance issues. This involves 1. Understanding the nature and potential impact of the finding. 2. Consulting relevant internal policies and procedures. 3. Escalating to appropriate subject matter experts, compliance, legal risk. 4. Gathering all necessary information and evidence. 5. Developing a response plan in consultation with experts. 6. Implementing the plan and monitoring its effectiveness. 7. Documenting all actions taken. This framework ensures that decisions are well-informed, compliant, and aligned with the company's ethical standards and regulatory obligations. Question 18. The performance metrics show a significant increase in the value of a particular investment product offered by Old Mutual, driven by a temporary market anomaly. As a junior financial advisor, you are aware that this anomaly is unlikely to persist and could lead to a subsequent decline in value. How should you proceed when discussing this product with potential clients? Option A. Advise clients to invest heavily in this product due to its recent impressive performance, assuming the trend will continue. Option B. Avoid discussing this specific product with new clients until the market anomaly has fully subsided and the product's long-term performance is more stable. Option C. Proactively disclose the temporary nature of the market anomaly and its potential impact on future returns, ensuring clients understand the risks and rewards. Option D. Highlight the recent strong performance to attract new clients without extensively detailing the temporary factors contributing to it. The correct answer is C. Proactively disclose the temporary nature of the market anomaly and its potential impact on future returns, ensuring clients understand the risks and rewards. Explanation. This scenario is professionally challenging because it requires balancing the company's financial performance with ethical conduct and regulatory compliance. A junior financial advisor at Old Mutual is presented with information that, while not explicitly illegal, could be interpreted as misleading to clients if not handled with transparency. The pressure to meet performance targets can create a conflict of interest, tempting individuals to prioritize short-term gains over long-term client trust and regulatory adherence. Careful judgment is required to navigate this gray area and ensure that all actions align with Old Mutual's ethical standards and the relevant regulatory framework. The correct approach involves proactively seeking clarification and ensuring full transparency with clients. This means not only disclosing the information, but also explaining its implications clearly and honestly. This aligns with the principles of client centricity and fair treatment of customers, which are fundamental to financial services regulation. By prioritizing open communication and client understanding, the advisor upholds their fiduciary duty and maintains the integrity of Old Mutual's reputation. This approach directly addresses potential client confusion and mitigates the risk of future complaints or regulatory scrutiny. An incorrect approach would be to downplay the significance of the performance metrics or to present them in a way that emphasizes positive aspects while omitting crucial context. This could lead to clients making investment decisions based on incomplete or misleading information, violating the principle of providing suitable advice. Another incorrect approach would be to ignore the metrics altogether, hoping they will resolve themselves or not be noticed. This demonstrates a lack of diligence and a failure to proactively manage client expectations and potential risks, which could be seen as a breach of professional duty and potentially a violation of regulatory requirements concerning disclosure and client care. Finally, an approach that focuses solely on meeting personal performance targets without considering the ethical implications for clients would be a clear failure, prioritizing self-interest over client well-being and regulatory obligations. Professionals should employ a decision-making framework that begins with identifying the core issue and potential conflicts. This involves considering the impact on all stakeholders, particularly clients. The next step is to consult the relevant regulatory guidelines and Old Mutual's internal policies to understand the specific requirements and ethical expectations. Seeking advice from senior colleagues or compliance departments is crucial when faced with ambiguity. The decision should always err on the side of caution and prioritize transparency, client best interests, and regulatory compliance, even if it means potentially impacting short-term performance metrics. Question 19. Investigation of a potential misstatement in a client report prepared by a junior colleague at Old Mutual, where the junior colleague has expressed concern about the accuracy, but is hesitant to raise it due to fear of repercussions. As a senior team member, what is the most appropriate course of action to uphold Old Mutual's commitment to regulatory compliance and client trust? Option A. Advise the junior colleague to correct the report discreetly without involving management or compliance, emphasizing the need to avoid unnecessary complications. Option B. Take over the report and make the necessary corrections yourself without informing the junior colleague or any oversight bodies, to prevent any potential embarrassment for the team. Option C. Encourage the junior colleague to document their concerns and report it through the established internal whistleblowing or compliance channels, offering support and assurance that Old Mutual values transparency and will protect them from retaliation. Option D. Dismiss the junior colleague's concerns as minor and suggest they focus on their assigned tasks, assuring them that senior staff will review the report later. The correct answer is C. Encourage the junior colleague to document their concerns and report it through the established internal whistleblowing or compliance channels, offering support and assurance that Old Mutual values transparency and will protect them from retaliation. Explanation. This scenario presents a professional challenge because it requires an employee of Old Mutual to balance competing interests: the company's need to protect its reputation and financial stability against the regulatory obligation to act with integrity and transparency. The employee must navigate potential conflicts of interest and ensure that their actions align with both internal policies and the regulatory framework governing financial services in the relevant jurisdiction. Careful judgment is required to avoid actions that could be perceived as misleading or that could compromise the integrity of Old Mutual's operations. The correct approach involves a commitment to transparency and adherence to regulatory guidelines. This means acknowledging the potential issue, gathering all relevant facts, and reporting the situation through the appropriate internal channels for investigation and resolution. This aligns with the regulatory expectation that financial institutions and their employees will act with honesty and diligence, and will proactively address any potential misconduct or breaches of policy. Specifically, this approach upholds principles of good corporate governance and regulatory compliance, ensuring that Old Mutual operates within the bounds of the law and maintains public trust. An incorrect approach that involves downplaying or ignoring the potential issue would be professionally unacceptable. This failure would violate the ethical duty to act with integrity and could lead to regulatory sanctions against both the individual and Old Mutual. Such an approach demonstrates a lack of due diligence and a disregard for the potential harm to clients, the company, and the broader financial market. Another incorrect approach, such as attempting to resolve the issue unilaterally without proper reporting, would also be professionally unsound. This bypasses established internal controls and regulatory oversight mechanisms, increasing the risk of an inadequate or biased resolution. It could also be seen as an attempt to conceal information, which is a serious ethical and regulatory breach. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves 1. Identifying the issue and its potential implications. 2. Gathering all relevant facts objectively. 3. Consulting relevant internal policies and external regulations. 4. Reporting the issue through designated channels. 5. Cooperating fully with any subsequent investigation. 6. Acting with integrity and transparency throughout the process. Question 20. Strategic planning requires Old Mutual financial advisors to consider various factors when recommending investment products. If an advisor is presented with two suitable products for a client, one offering a significantly higher commission to the advisor, but the other being marginally more aligned with the client's long-term growth objectives, which approach best upholds regulatory and ethical standards. Option A. Recommend the product that is marginally more aligned with the client's long-term growth objectives, even if it results in a lower commission for the advisor. Option B. Recommend the product that offers the higher commission, as it aligns with the advisor's personal performance targets and the firm's profitability. Option C. Recommend a combination of both products to diversify the client's portfolio and potentially increase overall advisory fees. Option D. Recommend the product that is easier to explain and sell, regardless of its alignment with the client's specific financial situation. The correct answer is B. Recommend the product that offers the higher commission, as it aligns with the advisor's personal performance targets and the firm's profitability. Explanation. This scenario presents a professional challenge for Old Mutual's financial advisors due to the inherent conflict between client best interests and potential personal gain. The advisor must navigate the regulatory landscape, which prioritizes client welfare and transparency, while also considering the firm's business objectives. Careful judgment is required to ensure that recommendations are solely driven by the client's needs and circumstances, not by the advisor's commission structure or sales targets. The correct approach involves a thorough understanding of the client's financial situation, risk tolerance, and objectives, and then recommending products that genuinely align with these factors, even if they offer lower personal remuneration. This aligns with the principles of fiduciary duty and the regulatory framework governing financial advice, which mandates that advisors act in the best interests of their clients. Specifically, regulations often require suitability assessments and disclosure of any potential conflicts of interest. By prioritizing the client's needs, the advisor upholds ethical standards and regulatory compliance, fostering long-term trust in client relationships. An incorrect approach would be to recommend a product primarily because it offers a higher commission, even if it is not the most suitable option for the client. This constitutes a breach of fiduciary duty and violates regulations that prohibit mis-selling or recommending products based on advisor incentives rather than client benefit. Another incorrect approach is to fail to fully disclose the commission structure or any potential conflicts of interest to the client. This lack of transparency erodes trust and can lead to regulatory sanctions. Recommending a product that is overly complex or inappropriate for the client's understanding or risk profile, solely to meet sales targets, is also a significant ethical and regulatory failure. Professionals should employ a decision-making framework that begins with a comprehensive client needs analysis. This should be followed by an objective evaluation of available products, considering their suitability, cost, and alignment with client goals. Any potential conflicts of interest must be identified and disclosed transparently. Finally, the decision should be documented, clearly articulating the rationale for the recommendation based on the client's best interests and regulatory requirements.